Hello, everyone, and welcome to today's webinar. My name is Lucy Heavens, and I am VP of Marketing at Hakodo. Over the next 30 minutes, we're going to be looking at the importance of fraud and fraud checks within the trade credit or the B2B buy now, pay later process. This is part of a series of 6 webinars where we're unpacking the end-to-end trade credit process. So a couple of quick housekeeping points before we start. Firstly, the format for today's webinar is a panel discussion. So I'm going to be having a very informative discussion with my lovely expert here today. We've allowed plenty of time for questions, so please feel free to type them in and we'll address them as part of the conversation. And lastly, a recorded version of this webinar will be available and sent directly to your inbox after we've finished. So just to set the scene here, the lockdown restrictions that we had that were put in place a few years ago across the globe to counter the COVID pandemic led to an unprecedented increase in e-commerce and opened up, unfortunately, a big opportunity for fraudsters. So the impact of the pandemic on e-commerce fraud attempts has been felt globally. In 2021, 3/4 of online merchants reported a net increase in these attacks compared to before the pandemic. A recent study from Juniper Research found that the total cost of e-commerce fraud to merchants will exceed $48 billion globally in 2023, and that's from just over $41 billion in 2022. So what type of fraud occurs during the trade credit process, and how can we ensure that we're not approving credit for potential criminals? So thankfully, like I said, I do have an expert with me today, a fraud expert, which doesn't mean that you're a criminal, Nico. But would you mind just introducing yourself and telling us a little bit how you became to be a fraud expert?
Yeah, thanks, Lucy. So yeah, hi. So I'm Nicholas Rabinovich. I'm leading our data science and fraud team here at Hakodo. And yeah, I got into fraud about 15 years ago, really, and a bit by chance, because it's not really a topic you could study at university back in my days, at least. Yeah, I studied the statistics, probability, and yeah, got in the world of risk and fraud straight after uni, and I haven't moved since. And I guess, back to the point of being an expert, that's one of the reasons I really enjoy the fraud domain, is that you really never are an expert. Like, the expertise is about constantly learning in terms of how the trends are evolving and how fraudsters find new ways to go around controls that have been put in place.
Absolutely, keeping up with the criminals. So I read in a report recently that the most common type of fraud or common type of e-commerce fraud attack is known as friendly fraud, which basically occurs when a customer knowingly completes a purchase with their debit or their credit card, and then they dispute that purchase with their bank for a refund. So in 2021, nearly 40% of online merchants reported experiencing this type of attack. So what fraud does occur during the trade credit process, and how else, apart from this friendly fraud, are they targeting the merchants?
Yeah, so I guess, friendly fraud, and you mentioned COVID as part of the introduction. So friendly fraud and COVID, so quite a big increase in what I summarize as abuse fraud. So abuse would include friendly fraud, but can also include what's called first-party fraud, when someone is using their own identity or their own company details, but as bad intentions. So bad intentions can be having no intention to pay back the trade credit they got access to, or this bad intention can be raising a dispute with absolutely no ground for it. So this type of risk can definitely occur for digital trade credit solution, or people targeting this type of solution. And yeah, that's something we put some detection measures in place, whether it's an automated algorithm that would consider a number of different data points to be able to assess not only the willingness to pay, but whether someone has any intent to pay in the first place. Which these two questions are quite different, and the way you can predict this is different as well.
I suppose, I mean, the thing about the fraudsters is they want to get to the prize as quick as possible, right? So, you know, and yeah, it would be quite a long journey for them to kind of go through the whole kind of ordering process, say for 6 months, to sort of lull a company into a false sense of security before then they commit the fraud. It's not really their way, is it?
Oh yeah, you'd be surprised. You know,
Okay.
they're running a business, so that they want to get the quick money. But it's not uncommon for someone who's well intentioned to start paying fairly low value invoices, you know, to build up this trust with the supplier. And you know, with the trust comes a higher credit limit or a higher amount facility. And yeah, fraudsters would be happy to put in a bit of effort to see a credit facility that's 10 times the amount they would have gotten otherwise. So
Interesting.
yeah, see a bit of both.
Interesting. So again, I read recently that some believe that many organizations, they're losing around 7% of their annual turnover as a result of fraud. So, what are the dangers to organizations, being targeted by fraudsters, and particularly kind of thinking about that trade credit or that B2B buy now, pay later process? What impact does it have on it?
Yes. So yeah, we touched on abuse of first-party fraud, bad intent. The other element that can impact business greatly is impersonation fraud. So when a fraudster would pretend to be working for a given company, will try to place a purchase with a supplier, pretending to be from a completely different company. And this type of fraud, impersonation, tends to be operated by fraudsters that are a little bit more organized, when the bad intent and abuse tends to be mostly operated by opportunistic fraudsters, although some of them are a bit more advanced than others. But yeah, when you put these two together, the obvious risk to businesses is the financial losses of these fraud attacks. And when you say 7%, in your quote earlier, does seem quite high, but I guess that's a survey is never perfect, but at least it's a good indication. Well, one of the risks that comes with these financial losses and fraud, that they tend to escalate quite quickly and exponentially. So once fraudsters find a process or control something to exploit, they will double down very quickly and try to get as much value as possible. So that's the first point. Then the second damage is more around the reputational damage for the business, especially if we deal with impersonation fraud, especially if a fraudster was impersonating an existing client of that business. You would disappoint your good customers. If the fraud is big enough to make the news, then it will definitely impact the trust level your existing buyers or prospects would put into your company. And I guess the third point is more of a second degree or second effect impact. If as a business you're a victim of fraud with a great impact, as a business you'll tend to have a very strong reaction to it and put in place some very harsh controls to mitigate this risk. But the very strong reaction and harsh controls put in place will also impact your good customers that have been doing business with you for decades. And yeah, you may end up creating some attrition there by reacting too strongly.
Yeah, absolutely. Nick, something you said earlier is just playing on my mind a little bit when we were talking about how fraudsters are sort of being more clever, and they can, go through that process of sort of ordering and, lulling people into this kind of false sense of security before they then sort of hit them with the big fraud, the big order. And thinking about that, I mean, you know, how do merchants manage that internally themselves? You know, and obviously then, you know, where I'm leading with that is, you know, what's the benefit of, you know, of outsourcing it, or, you know, letting a company like Hokodo deal with that?
Yeah. So businesses can manage this fraud risk like very differently depending on the history of the business, how it's been done before, and you know, how far along the business is in relation to digitalizing their experience. And it's actually quite common to see like you know, less digital businesses to not really consider fraud risk as on its own, but you know, considering it part of credit losses that you know that can happen anytime. Um, and yeah, when making the move to a more digital approach to trade credit, yeah, some merchants will manage the move more easily than others. Um, but this move really necessitates, you know, to take another look at your existing controls and processes, and really building not only the most automated systems so you can scale your business, but also the systems that are that can evolve quickly enough to be able to cope with the ever changing fraud threats without disrupting the experience of your good customers. So in the end, you know, that's to do it well, that's a huge amount for a business to invest in. Whether it's the system, as I mentioned, people, or data and processes, and yeah, the benefit of outsourcing this to a third party, you know, really enables the business to focus on what they do, you know, on their core business, rather than trying to build up this side function and capabilities.
Yeah. I suppose it's having the kind of internal resource or the expert within the business, but then also having access to all of the other tools, you know, that you would need to, you know, to kind of to search, I suppose, you know, for potential fraud.
Yeah.
Yeah. And what, I mean, kind of unpacking that a little bit, what's quite interesting, I know we, like, as we've sort of spoken in the past, in terms of that trade credit process, you've got kind of fraud checks at different points of that, you know, of the process along the way of the cycle, right from when, you know, a merchant has a buyer that comes onto their site at the very first time and they want to purchase something, and you know, you approve and give them credit because you've done those background checks, versus, you know, then, you know, ongoing, you know, can you tell me a little bit about that? At what points of the trade credit process are we doing those kind of fraud checks?
Yeah, as early as we can, and as late as we can too, because the more we progress throughout the customer journey, the more information and data we gather. So, but yeah, you know, if we look at the customer journey, it really starts at the point of identifying a company. You know, from identifying a company, we'll gather some public data, you know, whether it's financial information or firmographics information, director information, and from there, you know, we can start getting some potential red flags very early on in the customer journey. And as we progress, then, as I said, we gather more and more data. So we'll gather data around the device that the buyer is using. We'll get an email address for this buyer. We'll get, you know, to capture some card details or bank account details if the buyer is willing to pay by card or direct debit at due date. And we'll also gather information about the actual journey and behavior that the user is taking within this checkout process. So yeah, so we put all of this information together, and you know, what we're trying to assess in the end is number one, does this buyer has any intent to pay us back? Number two, not in order of priority, but number two, whether this buyer has a relationship with the company that's buying the goods. And from there, we make a decision as to whether we want to accept a given transaction, automatically reject it early on if we can, or challenge the customer with additional friction if we think the risk is medium to high. So our approach is very much data-driven, and here to maximize conversion by putting friction to what we consider higher risk checkouts.
Yeah. And I suppose, the thing is with the merchants, if they were doing it themselves, is they've only got access to the data of, of what they know, whereas what we know is kind of a lot broader, because I assume that, as we're learning along the way, that we're kind of reusing that data as such. So obviously, if we've got some information, fraudulent information that we found out with one particular buyer, one particular company, then obviously if that buyer then goes to another one of a merchant that is a customer of ours, then we'll share that information, right?
Yeah, it actually works both ways. So it works for the negative aspects, but also works for the positive aspects. So if a buyer has been using a Ocado solution for shipping on merchant A, and we see good behavior, we've made sense of the purchase, and then goes on merchant B, maybe some elements have changed that, without that merchant A experience, we would have considered that's potentially risky. But because we feel comfortable from a previous purchase, then, we feel comfortable with the second one.
Yeah, fantastic. Makes sense. And Nico, lastly then, tell me, what kind of makes our trade credit solution in your eyes so so special? Why are we so special? Why is Hokodo's the way that we kind of manage fraud as part of that process so good?
Yeah, so I think what sets us apart from the rest is, well, the breadth of our data. So not only our internal data, but all of the external data sources that we're connected to. So abstracting that from the business to have to integrate this, and how we use this data. So having a data science team within Ocado from pretty much the get-go. That's making the best use possible of this external data we get, our own internal data, and to make the best risk decisions possible. I think that's one key element. And then more broadly speaking, I think as a business, we really see ourselves as an enabler for the merchant or for the business integrating our solution. And we work really hard at trying to understand what this business is after, and how we can optimize whatever part of the customer journey to achieve the merchant's objectives.
I had one question then I want to squeeze in actually before we finish. You mentioned that about kind of like automating sort of parts of the process. Can you tell me a little bit like that in your world, in the kind of in the world of sort of fraud? What's automated? How can it be automated?
Yeah, so I don't want to go too much in the technicalities, but now I guess as consumers, most people are aware of 3D Secure on cards, when sometimes you get challenged with an SMS, but now more and more often by opening your banking app and validating, yeah, it's you placing this purchase. So in our trade credit world, we're trying to do the same thing, but to validate either someone's identity or relationship with the company, or to make sure that someone has good intent. And it's actually very challenging to do in an automated way, because only a few controls available out there are relevant for the risk we're trying to mitigate. But yeah, if I was going to quote a couple of them, so the first, I guess, common one between B2C and B2B would be an identity verification request. Except that on the B2B side, you need to make sure you trust this individual that's at checkout is in relation with the company that's buying the goods. Then the second one would be an open banking connection. So by requesting someone to log into open banking and being able to link, these banking details with the company purchasing the goods. That's an automated way to get this trust. And I guess the last one on bad intent, there may be some opportunities to, instead of rejecting a potential customer and transaction because there are doubts, we may be able to accept this transaction as long as the buyer is willing to pay a small portion upfront, for example.
Okay, interesting. That's great. Thank you. Well, we've come up to time now. So yeah, thank you very much for that. It was really interesting. I hope the audience enjoyed it too. And yeah, enjoy the rest of your day. Thanks, Nico.
Cool. Thank you very much. Have a good day. Bye.